Hello, Keith Prather here with the Farm Equipment Demand Index update for this month. Let me share. Okay, so this month it was interesting. We saw a flattening of the actual demand index. It was unchanged month over month, but it was still about 3.6% lower year over year. And you can still see against the long-term trend line, still depressed, still down lower than what obviously we'd like to see it at. Now, I still would point out that even though the demand index is still higher than it was prior to the pandemic, and it may not feel that way in our dealership showroom floors because we're remembering what it's been like over the last few years. Yeah, but we're still seeing at least demand at a level that was good historically, if you will. So it came in at 59.6. Again, not moving a lot. We've seen it really flattened out. So it's almost like the industry is trying to hit a point of equilibrium, and maybe we have. So a couple more things that we wanted to point out. So when we look at the industrial production, it's a little bit of an uptick month over month. So about 1.3% higher month over month, but it was still about 6% lower year over year. Um, this will be interesting because there's still a lot of inventory that we're going through, and once we get that inventory used up, then we'll see the industrial production numbers start to pick back up. So dealer activity, dealer sales will move probably before we start to see a little bit of this production move, and that's just going to be that process of trying to get inventories back down and consuming a little of what's already out there on the market. But when we look at the Purdue Capital Investment Index, it's kind of interesting because we saw some real fear and trepidation that kind of kicked in earlier, I guess after the first wave of tariffs, right? The whole investment index had gotten a lot of hope and optimism kind of coming into the end of the year, and then we saw a little bit of a pullback. But it has now recovered and gotten back up to a level of 61, which is an investment level that, again, we haven't seen since going back to 2021. So this is a really strong signal. It's not as high as it was maybe going back into some of the periods prior to the pandemic. So you still see, Purdue was showing that it was up averaging in the kind of mid 60s to high 60s through big chunks of the, 2017, 2018 era. But at 61, that's not bad. That's actually a big improvement over what we've seen, again, since the lockdown period. And there's a lot of expectations that they're going to start to spend, and we're going to see the farming community kind of come out of, some of the pain and suffering that they've been under. Um, I want to show just real fast the machinery sector outlook, and this is a forecast that we have after the tariffs were imposed on April 2nd. So this is a brand new curve and showing new growth kind of through that period. And it's interesting because overall, we would expect this to be decelerating and being pulled back. And right now, we're just not getting that signal. So we've got a lot of catch up to be done. If we do see the machinery sector kind of hit these levels, and this is going to be primarily ag, there's a little bit of transportation in here, maybe a little bit of construction in this. But you still see possibly a machinery sector that's growing at rates that we haven't seen since about 2022. And then prior to that, you've got to go back to about 2018, 2019 to see a stronger machinery environment. So a couple of things I want to talk about specific to the farm and ag industry. Right now with the trade negotiations, there's two different components to those negotiations. There's the tariff side of things, and then there's the non-tariff side of things. So let's take Vietnam, for instance. Vietnam has a 9.2% tariff against US goods. The US prior to April 2nd had a 2.2% tariff against Vietnamese goods. What we thought was going to happen on April 2nd is that the US would just raise our tariff to match the Vietnamese tariff. So we'd both be at 9.2%. But what the Trump administration said is there are a lot of what we call non-tariff trade barriers preventing a lot of US products from going into a lot of those countries. And it's that he wants to really go in and negotiate. So Vietnam offered immediately to take their tariff from 9.2% to zero, and the US could leave ours at 2.2 or do whatever we wanted. And Trump administration said, no, not good enough. We really need to negotiate those non-trade barriers and get those removed. The reason why I bring it up and why I spent some time on it is because some of the biggest trading partners in the world, like South Korea, Japan, some of our great trade partners, have a lot of barriers, trade barriers put up against U.S. agricultural exports. China's a different story, but a lot of our great partners are barring or they find ways to kind of slow down or prohibit U.S. ag exports. So part of this whole process is to go in and open those markets back up to make sure that they will take U.S. agricultural products and at the same time make sure that there are thresholds that those countries have to meet. And if they don't meet those thresholds, that there's sort of a punitive response for the United States already built into the trade deal that says to, like, a Japan, for instance, if you don't allow US beef into Japan at a certain level, then all of a sudden it triggers a specific tariff. And those are the kinds of things that they're working through right now. Many of these sort of non-tariff trade deals can take upwards of 2 to 3 years to normally negotiate. They're thousands of pages long. And what we're basically trying to do is cram those negotiations into a 90-day period. And that's really what this is all about. So the US really, you know, it sounds like some officials, because of especially the China trade bloc and where we're headed with China, could be setting aside up to $300 billion for more farm bailouts. When we had the trade spat in 2018 and 2019, the Trump administration paid nearly $20 billion to help farmers out, primarily because China had blocked a lot of imports of soybeans and a lot of other grains. And we just issued another 31 billion in farm aid to recover from the past 2 years. We estimated about 3 billion of that would be going into farm equipment purchases. So if we're forced to come in and create this kind of a bailout, that's pretty significant. And I don't think the administration wants to do that. So what they're going to do, I think, is focus real heavily on trying to get enough countries outside of China to lift those agricultural trade barriers so that it can offset any impact that we would get if the Chinese trade negotiations go very difficult, or if they don't ease up and don't free up the movement of, imports of soybeans into China, those kinds of things. So we'll see what happens. A lot of moving parts here, but I think over the next 30 days to 60 days, you're going to start seeing the very first of these trade deals get announced, and we'll look and see what the ag component of those trade deals are. Supposedly, at the time of recording, and we delayed these recordings a little bit, hoping that we would just get one of these announcements, but we were supposed to get a trade announcement on May 2nd. Then we were supposed to get it May 5th. Now they're saying maybe by the end of the week, this week. So we're recording on May 7th right now, or early next week. So watch for that. I think that's really going to set the tone for what we see in the next months ahead. But for now, U.S. GDP is still pretty stable. We've got a good consumer. Consumers still spending. We see some food prices coming down, which is going to help with a lot of household spending. And we've got a lot of other moving parts out there. We could do an hour just on the ag industry alone and what's happening with, like, beef imports from Mexico, what's happening to the beef industry itself. We talked about it in previous months, just that there's just a tremendous amount of demand, and hopefully ranchers will get to the point where they've got the money and the wherewithal to be able to go out and spend on equipment. So again, amid all the tariff challenges and all the tariff pressures, it looks like we've got a pretty favorable environment ahead for potentially some spending, despite core commodity prices being pretty low. Wheat, soybeans, corn, a lot of those commodity prices are still pretty low at the moment. And so that kind of poses a little bit of risk on the marketing side, but the cost and input side of things is coming down. And so that will help. So again, we're kind of thinking about the first half of the year. Looks like from a GDP perspective, it's pretty flat. Second half accelerates. For the full year, we're still looking at some growth. So we don't see necessarily huge recession risk. We may hit a recession just technically by definition only, but we don't think it poses any long-term risk there. So that's what we've got for you this month. Hope everyone, stay safe. Hope you have a great month, and we're looking forward to talking to you next month, and looking forward to having some deals and some announcements and be able to break down some of the trade deals for you once we get those. All right. Okay. Take care, everybody.